Afternoon, everyone. It's coming up to 2 p.m. New Zealand time. We'll just give it a couple of minutes before we get underway. Thank you for joining us. Okay, it's now on the hour of 2 o'clock on Friday, the 29th of July. My name's Gary Roloff. I'm the co-founder and CEO of Laybuy. With me is Mark Connolly, our CFO, and we're very happy to be presenting to you this afternoon our Q1 FY23 results and a strategic update. Mark and I have put together a brief presentation for you. We'd like to run through these slides, explaining them as we go, and then we'll have time for questions at the end. If you could please use the question tool that is available via the webinar, and we will answer those as we work through them. So without any further ado, I'll get underway. So I'd like to kick off with a little bit of a background or update on the strategic review findings that we have had as a result of the work we've been doing with capital that was announced back in April of this year. The review is now completed, and it reaffirms our commitment to both the UK and ANZ businesses. The release that we put out after the June annual result indicated that we would be looking at exiting or restructuring the UK business, and that's what we intend to do. Our review confirmed our pathway to profitability and provides us with an assurance on the sustainability of our business model. We looked at the sale or partial sale of the business and determined that with what we were seeing, it was not in the best interests of our shareholders or our people. We have enjoyed success in our fraud prevention program, which has provided the board and I, Mark, and the rest of the executive team with alternative options. We have initiated a major cost reduction program that will see us achieve profitability across the group by Q4 FY23. For those of you who are not familiar with the company, our financial year ends 31 March. Heartbreakingly, this means that we will reduce our headcount by about a third of our people. That equates to around 45, but that delivers significant savings to the business. A reduction in costs elsewhere across the business, alongside a continued investment in fraud and credit risk management, will remove the need for a capital raise in the medium term. I can't stress that enough. We do not envisage any need for additional capital in the medium term. We are now on track to be one of the, if not the first, profitable pure play buy now, pay later provider on the ASX. And that's really exciting. But I have to say it's bittersweet, because this does impact a third of our people. And that has been a very difficult message that we have had to deliver last night. So our strategy to achieve profitability. We have embarked on a saving to invest program quite early in this year and have been working across the business to identify areas where we improve efficiency, where we reduce cost, and reprioritize our spending, so that we are investing in areas that provide the strongest return to support that pathway to profitability. We are focusing on increasing the quality of our customers and merchants. We are focusing on ensuring the customers that we onboard into Laybuy are capable of repaying us, and we are not putting them into an unsustainable debt position. This is consistent with our values around responsible lending, but also ensures our path to profitability is maintained. We've tightened our approach on credit risk, and that is key in terms of how we will support profitable growth across the company. And of course, that is least likely to attract fraudulent and credit defaulting activity. We will continue to take a proactive approach on security of our platform, and that will include investing in fraud prevention and intelligent software. We have been successful in reducing our defaults and fraud, and Mark will talk to that shortly, but that is a credit to our team, and particularly our credit risk office team headed by Jamie Biles, who has recently joined our business. So I'd like to spend just a little bit of time talking you through the company restructure that we announced yesterday. The restructure reflects a reorientation for our business from high growth to achieving profitability in the short term. When we launched our business and subsequently listed on the ASX, the market wanted to see us grow. In fact, one analyst told me after one quarterly review, your NTM is too high, you're not growing fast enough, and that is reflected in the too high NTM. We are now only interested in growing profitably so that we achieve our goal of being one of, if not the first, profitable pure play BNPL on the exchange. As I've indicated, very sadly, our headcount will be reduced by about a third. The majority of the team that's impacted is from our Auckland head office, which is our operational hub, although there are a number of roles, sadly, also impacted in the UK and in our Australian office. We've always been a pretty lean operation. We've prided ourselves on being a lean operation and a streamlined operation. But this new structure streamlines our operations further. It means we change the way we do things, and we believe has very minimal impact on our customers or our merchants. And ultimately, it delivers significant savings that we can pragmatically invest in the business where there is a higher return on that investment. I'm going to pass you over to Mark, our CFO. He's going to update you on what we have been doing and the results we've been achieving through our credit risk management office, and then we'll talk us through the financials. So thank you, Mark, over to you.
Thanks, Gary, and it's a pleasure to be here for my first webinar and presentation to you for Q1 FY23. I'd like to just pick up on some of the comments that Gary made in terms of the appointment recently of our Chief Risk Officer, Jamie Biles, who's based in the UK. And certainly a focus for Jamie over the first quarter of his time with us has really been on proactively managing credit risk. And we've seen some really significant improvements already in this Q1 that we're delighted to report on. It's been a real strategy of ours to focus on fraud prevention, and that has seen strong results with significant reduction in losses attributable to fraud in Q1 of FY23. Gross losses have fallen by 210 basis points, supporting an increase in NTM from a minus 5.5% to a positive 1.4% in the current quarter. This strong improvement in NTM has been throughout the quarter and steady, with NTM in June itself being recorded at 1.9%. Particularly pleasing within that was that the UK NTM for the month of June was 1.7% positive, which is a real turnaround from the negative NTMs that we experienced in the last 3 quarters. We're continuing to implement steps, including investing in fraud protection technology to improve the security of the Laybuy platform. And we'll continue to increase focus on attracting and retaining quality customers, as Gary mentioned, and merchants to further reduce the risk of fraud and default. The progress made in this quarter in credit risk has really been a significant factor in giving us confidence to move forward with the current strategy that Gary has outlined to you already. Before I hand back to Gary, I will go through the Q1 Q1 financial year 23 financial highlights. And I will signal here that as we go forward with future presentations, we will start to amplify more appropriate metrics that underpin our focus on, or increasing focus on, profitability as we go forward. But in the meantime, I would call out our GMV recorded for Q1 at 215 million, recorded as the second highest quarter for GMV in the company's history, noting that the highest quarter was in fact the December quarter of calendar 21. So taking away the seasonality, this is an outstanding result from a GMV perspective. And within that, the UK GMV for the quarter was 128 million, 34% up year on year. Our total income up 9% year on year at 11.3 million. And as I've already mentioned, our net transaction margin, NTM, up 190 basis points at 1.4% for the quarter, which is outstanding. And just thinking about customer and merchant metrics, we have 918,000 active customers at the end of the quarter, which is 12% up year on year, and noting that the UK within that is up 19%. And active merchants, 14,000 at the end of the quarter, 39% up year on year, which is a great achievement. These graphs that you'll see on the screen just show the quarterly development for GMV and the other metrics that we've already talked to. Noting here that the annualized GMV that we reported for the quarter is now 860 million. And on a moving annual total basis, it's 36% up year on year, which is outstanding. Active customers, you'll see a slight decline in the quarter, which really reflects our shift in focus to quality customers and making sure that we're attracting the right customers into our business that will deliver on profitability for us and also protect those customers coming through. Just going down below that into the UK, you'll see the UK GMV for the quarter at £66 million, second best on record, and obviously with the exception of Q3, which was the December quarter. So if you take out that seasonality, a strong result for GMV. A slight decline in active customers in the UK, but again reflecting on that quality customer, and really good to see growth in active merchants in the UK. So we're still recording significant growth in active merchants, which is good. In the Australia New Zealand market, a reasonably steady GMV growth, 87 million GMV for the quarter. Active customers again showing a slight decline, which again consistent with our focus on quality customers, and a steadying off of active merchants, which just reflects a more mature market in the Australia New Zealand market that we have here. And lastly, before I hand back to Gary, is just a summary of our current strong debt facilities. You see that we've got facilities with Partners for Growth that supports our UK business or our UK loan book, and we've got a facility with Kiwibank that supports our Australia New Zealand loan book. Both facilities are strong and appropriate to cover us and have sufficient capacity to support the current and forecast needs for the business over the next 12 months. Okay, I'll pass back to Gary.
Thanks, Mark. Great job on that. Appreciate it. So I'll just quickly run through you our final slide, which is our outlook for FY23. I think I've been pretty clear. Our focus is on achieving short-term profitability. Our ANZ operations, excluding our group overhead, are already profitable, so they give us a very good benchmark. We will continue to prudently manage costs and focus on driving efficiencies through the business and reducing fraudulent activity also. The tightening approach to credit risk and focus on quality customers is undertaken as part of that fraud prevention strategy, ensuring we get better quality customers through the top of the funnel. Our risk of credit loss is mitigated during a tighter macroeconomic environment so that vulnerable consumers are protected from unsustainable debt. That is consistent with our value set of being a responsible lender. We are very mindful of the macroeconomic issues facing everybody across the 3 territories in which we operate. And the tightening of credit rules that we have put in place is designed to protect the company and our consumers. As I've alluded before, given our capital efficient model, we turn our capital faster than any other buy now, pay later in the market, given our weekly payment cycle. We're well positioned against the rising interest rate environment. Our exposure to rising interest rates is minimal on 2 counts. Obviously, the capital efficiency I've spoken to, but the fact that our facility in the UK is a fixed interest rate facility anyhow. So we have no exposure to interest rate increases in the UK. And in terms of the regulatory environment that we're seeing playing out in all 3 territories, we are in regular discussion with the regulator and the officials. We are confident of our position in the market, and the things we do align to where the thinking currently is from the discussions we're having. As I've alluded, our restructure delivers significant savings to the business and ensures we are adequately funded without the need for external capital. That's exciting for us. We do not have a need for external capital based on what we are doing with the program of restructure. And that's exciting and sad. It's exciting for the business. It's really sad that 1/3 of our colleagues have to be part of an exit strategy for them. But we need to do this for the sustainability of our business. Where appropriate, the capital that we have in the business will be invested back in to support our pathway to profitability. And our expectation, and all the very thorough work we have done through Mark and his team and external providers to review our model, creates the confidence we have in being a profitable and self-sustaining business by the end of FY23, 31 March. As I mentioned earlier, we are on track to be one of, if not the first, profitable pure play buy now, pay later provider on the ASX. That is bittersweet. But the reality is we need to do this for the health of the company and for the benefit of the people that will be remaining in the business and our shareholders. So thank you for your time. We will now answer any questions you may have. And we do have a couple come through. Question from Dion. Thank you, Dion. Hi, 3 parts to the question. Do you have any share price goals? When do you expect to pay dividends? And what is your dividend policy like to be paid? Do I have any share price goals? Absolutely. I want to be back through the high we enjoyed after listing. That was $2.30. When do you expect to pay dividends? That's a board decision and one that we have not addressed right now for obvious reasons, but you can be assured that we will be communicating with the market when that decision is made. And I think that answers all 3 of your questions. Dion, I hope that's answered for you. We have an anonymous attendee. What types of roles have been caught up in restructure? Sadly, they are across every single facet of our business. Louise, are you going to do capital raisings and dilute holdings? Louise, this restructure means that for our company, we have no requirement for a capital raising in the medium term. We are self-sustaining as a result of the profitability route we're going down. See if there's any more questions. Anonymous attendee. Can you please explain why the pending cost of fund increases isn't much of a concern for the type of business? Two ways of answering that. The first is half of our funding lines are fixed interest rate. And in fact, more than that, because the UK is about 65% of our business, Mark, and that is on a fixed interest rate environment. So we have no exposure to interest rates on that. The other half is floating. And we have calculated that a 200 basis point increase in the underlying interest rate adds 40 basis points to our cost of sales. So it is immaterial in what we are looking to achieve. We do not have a material exposure at all to the rising interest rate environment. Our consumers do, which is why we're conscious of our credit risk profiles. But as a company and our cost of funds, we do not have that exposure. From Hamish, with profitability anticipated by Q4 23, do you plan to embark on aggressive growth thereafter, and would you consider a future capital raise to achieve this? Hamish, I think we're being very clear. Our focus is on being a profitable business. For those of you who have heard me say this before, I'm a former retailer CEO of some 16 years. I'm not used to running a business that loses money. Mark comes out of a retail background as well. We know that as a retailers, you keep losing money, you're out of business. We are going to be a profitable business and grow sustainably and profitably. I hope that answers your question, Hamish. Oh, Louise. What are the late repayment fees and how are they managed? I'm not sure I understand your question in detail, Louise, but our late payment fees are $10 capped at 40 on any one transaction and £6 capped at £24 in the UK. See if there's any further questions. Hamish, can you please elaborate on what your fraud mitigation strategy has been? Hamish, obviously we've got our own IP, but we have a very experienced CRO in Jamie Biles. He's a 25-year fraud and credit risk veteran, most recently out of HSBC. The skills and tools he has brought to the business over the last 5 months showed green shoots relatively early, but over the last 3 months, we have gained enormous confidence in the things he has been able to implement for us. And I guess that's our secret sauce that he brings. And I don't think it's appropriate to share that. We'll just keep that to ourselves and keep doing it. Louise says, thanks, and let's hope the share price starts climbing. Agree, Louise. Did for the last couple of days, but it would appear that the market is taking a little bit of a breath on all buy now, pay later today. But it is very heartening to see our share price lifting into double digits, I can assure you. Anonymous attendee. An article published in Stuff last night quoted, there was strong interest in the business with a number of investors expressing an interest in acquiring part of the business. Are you able to elaborate on that? Yeah, sure. We did have strong interest in various parts of the business, but when we looked into those deals, Mark and I and the board made a conscious decision and a very thorough investigation of those options that they were not in the best interests of our people or shareholders, and that a path to profitability as a combined entity that we took control of our own destiny was the right way to go. Anonymous attendee, triple CFA regulations in New Zealand are heating up, the focus on BNPL sector coming. Are you ready? Should there be a greater demand on onboarding verification and good customer outcomes? We're very ready, anonymous attendee, and have been in regular discussion with both the MB officials and iwi as well. So we are all over this, and it does take up a fair amount of my time, to be fair. Anonymous attendee, with retailers likely to face tough conditions over the next 12 to 18 months, do you see any pressure on the fees you charge? Very short answer to that, no. The value we are generating to retailers is recognised by them. And quite frankly, we have entered into conversations that demonstrate the value we have to retailers, and we're not seeing any price pressure. Jenny Z, if a recession hits, how is this going to impact Laybuy? Jenny, I wish I had a silver ball, but what I can tell you is the credit risk and fraud risk management tools we've put in place will ensure the company is protected from credit risk exposure, and we will be protecting our consumers from getting into an unsustainable debt position as a result. Dion Jones says, thank you, great progress and result from the strategic review, all the best. Thank you, Dion, it's appreciated. It's been a very intense few months for us, and will be a very intense next 12 months and beyond, but we are delighted to be able to produce these results and a clear path to profitability in the coming weeks, months, and year. So look, there's no open questions. On that basis, I'd like to thank you all once again for joining us this afternoon. Thank you, Mark, for your presentation, and we look forward to updating you on our progress towards our stated goal of being profitable Q4 financial year 23. Thanks very much, everyone. Goodbye.
Like Christian.
Thank you, Brad, for your